So now we're going to actually look at a problem that deals with the imputation of interest. So these are special notes payable situations. I have two situations we'll go over. And the friendly reminder is that if a company can't determine, say, the fair value of the property, goods, service, and other rights, and if the note has no ready market, then this makes it a little bit difficult for us to ascertain present value. And we need present value in order to figure out interest rate. So we have to approximate an applicable interest rate. And that happens by looking at what prevailing rates are for similar instruments, whether there's collateral payment schedules. We determine the imputed rate at the point of issue of the notes payable, and then later rate changes in situations are just largely ignored. So to begin with, we have to take some information into account, and for us, I have posted this right here in the problem. I'll go ahead and read the first one because we will do both of these. We will have a sheet that we will do for A. Then we have a sheet that we will do for B. So for A, it says on January 1st, 2017, Robin Wright Incorporated purchased land that had an assessed value of $350 at the time of purchase. A $550,000 zero interest-bearing note on due January 1st, 2020 was given in exchange. There was no established exchange price for the land, nor a ready fair value for the note. The interest rate charged on a note of this type is 12%. So we're going to determine at what amount the land should be recorded on January 1st, 2017. And the interest expense that will be reported in 2017 related to this specific transaction. So that's a lot of information that came at you at once. And again, all of that information is detailed right here. This is an exact copy of what I read you. So let's kind of start with some known factors and what the problem actually tells us. So we know that the transaction occurred. So the date of issue is 01/01/2017. And I almost always do this. I put in the things I know. And that it was land that had an assessed value. So we have at least something that was given to us, $350,000. And that was the assessment at that date. We issued a notes payable of $550,000. And the due date on that is January 1st, 2020. So that gives us a term of 3 years, which is also 36 months. A lot of times in loans, they actually tell you how many months. We know that typical, similar instruments rates are 12%. So we're looking at value of the land for recording on 01/01/17, and then we are looking for the interest expense accrual amount for 2017. So these are our two calculations we're looking to do. So for the first part of it, we have the face value of the 0% interest-bearing note. That's what this is called because it's not defined. We know that face value, and what we will pay on January 1st, 2020 is $550,000. There's some other facts that we know. We know that this has a term of 3 years. We also know that similar instruments have a 12%. So because it is a similar instrument, we can use that value. So we need to go to determine what the discount factor is going to be on this at 12% for 3 years. I go to the present value of 1, so this is one single amount, 12%, 3 years, and that is 0.71178. So this is our discount factor, 3 years, 12%. So the amount of the note attributable to the land, so this is what would be recorded for the land, 010117, is going to be 300.7. Now that doesn't make sense. What did that do? Oh, because I did it as a minus. My apologies. Is $391,479. So on January 1st, because we would have to go through some entries, and the entry when we issued this would be, we would have land, 391,479. We'd have a notes payable, right? That notes payable is $550,000. Well, that's a bit of a conundrum because it's not going to be equal. We would use our discount on notes payable account, and that would account for the difference. We would need to amortize this discount over a period, meaning that the carrying value of our note is going to change periodically. It's going to change when we recognize our interest expense. So to determine how much interest that we would recognize, so let's just insert us, and let's shift those guys down just a line. This tells us the value of the land. This was our goal. Now we're looking to do our interest expense accrual amount for 2017. We've gone through an entire fiscal year. We will not be paying this until this loan matures in 2020, but we receive the benefit of the funds for a year. Therefore, we need to recognize that interest for this year. So we start with the carrying value of the note payable. And we know that that's the amount that is recorded for the land on that day, because it would be notes payable less discount on notes payable. So to make that even just a little bit more clear, let's say notes payable, less discounts on notes payable. We have our carrying value of our note on January 1st, 2017. We know the applicable interest rate, right? Because for similar instruments, it's 12%. So we multiply that by 12%. That gives us $46,977. This is the interest rate to be entered for 2017, the amount of interest expense. So just to make things a little clearer, so this is interest expense 2017. So just to go ahead and continue, we'll show you what that journal entry would be. We would have our interest expense of $46,977.48. And then we would go to discount on notes payable. $46,977.48. If we were to do a real quick T account, just because I kind of feel like doing it. So let's give me a bottom border here. And let's just give me a right border here. Actually, let's not do it in the T account, because it's more difficult to portray that away. So let's just clear all the formatting from that. So our notes payable account is $550,000. When we portray our notes payable, we are portraying it at carrying value or net book value. So on 01/01/17, we had the discount of negative 158. Whoops, yeah, 158,521. Because that's a contra account, so that's why I'm portraying it as negative amount. That gave us carrying value of the $391,479. Now we went ahead and removed some discount, and that was in the amount of $46,977.48. So we'll add that. That's going to give us a new carrying value of this. Our discount account started with 158,521, and we'll say a contra account number of 158,521, had a debit amount. I went and I credited it, and I credited it $46,977.48. That means that its new value is going to be a debit amount of $111,543.52. So to determine the carrying value, it would of course be notes payable less the discount on notes payable, or $438,456.48. There's multiple ways you can actually come at this, just so you're aware. I actually realize that I did this on the B's tab, so let's just go ahead and rename the A tab B tab. And this is exactly how you go about completing this. If you have any questions, remember, go through what you know and see if it gives you enough information to determine what an applicable rate is for a current period in time, what that rate is and what the periods are, and that you, of course, need to discount that back to find out what the real true value of the land is at this time. Even though they did tell us that it had an assessed value of $350,000, that is not the equivalent of what we paid for it. When all is said and done, assuming a 12% interest rate, we're actually paying $391,000 for this, as far as land cost value, not cash that left per se. So for example B, it tells us that on January 1st, 2017, Field Furniture Company borrowed $5 million face value from Gary Sinise Company, a major customer, through a zero interest-bearing note due in 4 years. Because the note was zero interest-bearing, Field Furniture agreed to sell furniture to this customer at lower than market price. A 10% rate of interest is normally charged on this type of a loan. So they want us to prepare the journal entry to record this transaction and then determine the amount of total interest expense to report for 2017. So let's flip over to example B and let's just start noting the things we know. So we know that it started in 01/01/2017 as the date of issue. This is where interest is going to start accruing, right? At the date of issue. Then we are going to look and see. So face value, the amount that was borrowed is $5 million. It is zero interest bearing. And we're going to be selling furniture to the customer at lower than market rate using a 10% rate of normal interest. So we have a 10% for similar notes. So let's discount back and try to figure out at this exact point how much of this is notes payable and how much of this is attributable to our discounts and our unearned sales revenue. So this is a very tricky kind of a problem. So the first thing we know is that we received cash, right, of $5 million. We also have a notes payable of $5 million. Well, isn't that just a conundrum because we don't have anything to discount yet, per se. We received 5, we're going to pay 5, and we're going to pay that out in 4 years. So we have a 4-year term, which is 48 months. But where's our interest? What do we do when we figure out what this really discounts back to? Because we want the present value currently. Because we have made that agreement to sell them at furniture at less than market, it's determined to be unearned sales revenue. Now, your unearned sales revenue will be your offset for your discount on notes payable. We will go back to my friend here, and we are looking for 4 years and 10%. If I recall correctly. Yes, and that's 0.68301. So when we multiply the present value factor of 0.68301, this is going to give us the present value that we need to reflect for the note. So face value times 0.68301. This means our discount is face value less present value, or $158,905. $1,584,950. That means our unearned sales revenue is also that same amount, because that is what we are giving up. That is our cost of borrowing. That is what we are looking for, is what the cost of this borrowing is going to be. So to start off, we need to start with our carrying value of our note. Carrying value of your note is notes payable less discount on notes payable. So notes payable less discounts notes payable, or the present value of the note on January 1st, 2017. We know that a normal applicable rate of 10%. So interest for 2017 is going to be 10% of the 3.415, or $341,505. This was a little bit more complicated and definitely a little bit more tricky, because the amount that we received in cash is the same amount that we'll be paying back in cash. But there is an inherent cost, and the cost in this is actually in that amount of sales revenue that we won't be collecting, because we are going to allow them to purchase at less than market. So then we have to go in and we have to impute an interest rate and calculate it and then accrue it accordingly over the next 4 years.